Welcome to The Explainer. I am absolutely thrilled to dig into today's topic with you because we're tackling something that, at first glance, honestly looks like a massive financial mystery. Today, we are focusing on the iShares 20-plus year Treasury Bond Buy Right ETF. You probably know it best by its ticker symbol, TLTW. We're going to completely unpack what is actually happening beneath the surface of this fascinating fund, relying on some seriously excellent research from major holders.
Okay, so to really understand this, we have to start by addressing the elephant in the room. If you look at this fund's price from its inception in August 2022 up to May 2024, you're going to see a terrifying plunge of 43.4%. The price literally dropped from around 39 bucks all the way down to just over 22. Now, if you're holding this fund or even just looking at its chart, seeing a number like that, it's completely enough to validate your absolute worst financial fears. It just looks like a total disaster.
And you know what makes that drop even more jarring? The backdrop. During that exact same time frame, 20-year Treasury yields actually finished higher by a pretty modest 149 basis points. So you have this modest rise in yields, but the fund loses nearly half its price? Yeah, as the research points out, the casual reading of this situation is simply that the strategy just doesn't work. It is so incredibly tempting to look at that 43% decline in a vacuum and conclude, yep, this fund is totally broken.
But is this strategy actually broken? That's our central question today. Because if we shift our lens away from that casual reading and we start looking at this carefully and analytically, it reveals a completely different, honestly kind of shocking reality about how this covered call strategy actually behaves in the wild.
Section 1. 3 windows, 3 stories. Because as we know in finance, the story you see depends entirely on when you start the clock. Now, what's really wild here is the middle data point. Look what happens when we simply shift the start date forward by just 13 months to September 2023. Suddenly, that supposedly broken fund has a nearly 10% positive total return. And, even the since inception number, once you actually factor in the massive $15.33 paid out in cumulative dividends, is only a modest minus 4.5% total return. Look at the last 12 months, a solid positive 8%. It is the exact same fund, the exact same monthly data, the exact same dividend stream, but totally different outcomes based purely on your starting line. Moving along, we can see exactly how this builds out. We basically have 3 distinct windows of the fund's existence. The August 2022 launch represents the absolute worst drawdown. Then, September 2023 is where this stable yield era begins. And finally, June 2025 kicks off a steady-state normal year. Walking through these windows shows us exactly how that initial launch timing severely distorted the headline numbers that everyone talks about. Let's start with that inception window. TLW launched directly into literally the worst long-duration bond drawdown in modern memory. I mean, yields on the 20-year Treasury shot from 3.38% to over 5% within just 14 months. That was a once-in-a-decade rate spike. Any long-duration product out there was going to get absolutely crushed in that window. Because of that historically bad timing, massive duration damage was practically inevitable right out of the gate. But contrast that with the September 2023 stable yield window, and you get a totally different story. Across these 33 months, yields started at 4.87%, and they ended at exactly 4.87%. They didn't spike, they just kind of oscillated within a band. And in that environment, an investor booked a 9.8% total return. The really brilliant takeaway here is that when yields just move within a range, which, by the way, is the actual operating assumption of the fund, the strategy works exactly as it was designed to. Section 2. 4 mechanics of decline. Okay, so we've covered the what, but now we really need to pivot to the why. If we look under the hood to see the actual math driving the ETF's natural price erosion, it's absolutely fascinating. See, even when the total return is positive, like we saw in our stable yield window, the actual price of the ETF still grinds lower over time. This isn't some mistake. It's a structural guarantee driven by 4 distinct mechanics: the asymmetric trap, mechanical NAV reduction, volatility drag, and duration sensitivity. We're going to break every single one of these down so you can really grasp what's happening here. This perfectly illustrates the first and honestly dominant driver, the asymmetric trap. Think of it like a single round trip in the market. TLTW sells monthly call options on the underlying TLT fund, right? So if TLT rallies 5%, TLTW's upside is capped by those calls. It only gains about 1 to 2%. But if TLT drops 5%, TLTW absorbs the full downside, losing 4 to 5%, relying on just a tiny premium for a cushion. The net result after just one of those up and down cycles, the fund is down 2 to 3%. Run this exact cycle a dozen times over a few years, and you mathematically compound a structural trap that just relentlessly eats away at the price.
Then we have our second driver, mechanical NAV reduction. Now, this fund distributes massive payouts, often a 15 to 20% annualized yield. But here is the absolutely critical part to understand. This isn't organic income growth, like a company growing its earnings. These huge distributions are largely just option premium and return of capital. Because all this cash is constantly going out the door to pay you that massive yield, the net asset value of the fund has to mathematically drop. The cash going out to investors today is literally funded by selling away the fund's future upside. Driver number 3 is volatility drag. Simply put, this is the cumulative financial loss you experience in choppy up and down markets. Even in that amazing stable yield window we looked at, where yields started and ended at exactly 4.87%, there are still a ton of oscillations in between. And remember our asymmetric trap? Every single one of those dozens of small up and down oscillation cycles costs the fund money, because the rallies are capped, but the sell-offs are fully absorbed. This classic volatility selling problem is exactly why the price slowly decays, even in a perfectly flat market.
Finally, driver 4, duration sensitivity. The underlying assets here are 20-plus year bonds, which means they carry a duration of roughly 17 years. What does that mean for you? It means even a tiny 50 basis point shift in yields causes violent price swings. A small yield increase can drop the underlying bond price by 8%, which TLTW fully absorbs. But a yield decrease? It only gives TLTW a tiny gain because of those call options. The long duration basically takes that asymmetric trap we talked about and cranks the volume up to 10, which is exactly why that 2022 rate spike was so utterly devastating.
Section 3. Who should buy TLTW? With all of those mechanics laid completely bare, we really need to move away from judging this fund as simply good or bad. That's just not helpful. Objectively looking at the facts, TLTW is highly suited for income-focused investors who genuinely expect yields to be range-bound. It's fantastic for tax-advantaged accounts or retirement portfolios where you desperately need a cash flow supplement. And this is key. You completely understand that you're trading future price appreciation for current income. However, it is fundamentally not suited for investors seeking pure duration exposure or anyone wanting to ride the tonal returns of the underlying TLT fund during a strong rally, because those gains will always be capped. So the crucial point here is captured perfectly in this quote from the research. The covered call framing makes people instantly think of risk reduction, but that's a huge misconception. What this fund actually delivers is a return profile transformation. It fundamentally changes how the asset generates returns, converting potential future growth into immediate, massive monthly income, but doing so at the absolute mathematical cost of long-term price decay.
Because once you truly understand the mechanics, that scary 43% decline isn't a mystery anymore. It's literally just the math doing exactly what it was designed to do. Which leaves us with one final, kind of empowering question to apply to your own portfolio strategies moving forward. Are you looking for bond exposure for the income or for the duration?